Have you ever benchmarked your results against one of the major indices to determine all this time and effort you may be spending, is it paying off, or should you have just put all your money in the one index and gone? I would challenge anyone. You've had 5 years of success. Let's review this after 10 years and then 20 years.
You might get rich by being very active, by getting up early, by doing workouts, by calling a lot of clients, by putting in a lot of hours. But when it comes to investing, like over trading, that might kill you, right? So investing is just a different game. Yo, Neil, can you hear me?
Yeah, I can hear you. Can you?
Awesome. Yeah, I can hear you now also through
All right.
my headphones, which is nice. Hi, Chris.
Yeah, Sylvan, hi.
Hi, nice to meet you.
Nice to you're the guy, huh?
I'm the long-term trends guy, I guess. Yeah. But Chris, why don't you tell us real quick something about yourself and
Well, I do.
you seem to be a finance professional. Is that right?
That is correct, yes. So my two companies are behind me.
All right.
This one does 100% of the revenue. This one does 0 so far. This is like an online effort to help people buy annuities online. Very difficult to do. This one I've done for 25 years, normal American. We're called financial advisors. So I help people save and invest in mostly, mutual funds, registered, all vanilla stuff. Sylvan, mutual funds here in America, Vanguard, Fidelity, American funds, BlackRock sometimes, although I'm moving away from them. But I help people save and invest, and I keep a lot of data, but yours is a lot more visually pleasing than my massive Excel spreadsheets. Just congratulations. I think your site is fantastic.
Thank you.
And what I do, I keep stats. I call it market stats, like the Standard & Poor's index versus the aggregate bond index. And I keep those stats, and maybe USA versus international. You have a lot of other stats, and your graphics are just, I'm just some guy who uses Excel, but your graphics are brilliant with these charts and the scales. It's just wonderful to use. And so I use those when I'm helping describe to people, the advantages of long-term investing and such.
Yeah.
And, it's fascinating. This stuff is fascinating. I mean, in America here, sometimes, mostly stocks beat bonds.
Yeah.
But sometimes bonds beat stocks, and you have to be ready for it.
Yeah.
And who knows? And interesting, in your charts, the S&P or stocks versus gold. Stocks versus gold and silver, that was fascinating. I think right now for 20 years, is gold ahead? Is gold winning? I have to toggle the chart.
It's funny. I can tell you, like looking at the website analytics, this chart is super popular right now. A lot of people land there. I guess they Google it. They're interested. They probably hear something in the media how stocks versus gold has been almost an equal game over last whatever 10, 20, 30, 40, 50 years. And it's really all kind of gold comparisons actually are very popular right now because gold just rose so much year to date.
But what's interesting is if you toggle your time period to 10 years, S&P versus Dow Jones versus gold versus silver.
Yeah.
If you toggle to 10 years and you just kind of scroll and you see, well, they are beating, the commodities are winning now. Let's just say commodities are winning right now for 10 years. Very close. But if you then scroll backwards with the 10-year window and you go backwards in time, now it's interesting. What we call here in America the lost decade, 2000 to 2011, 2000 to 2010. We call that the lost decade. Stocks went nowhere. So gold won, gold and silver won. But prior to that, the percentage of time I'd be curious, your stats, how do I say this? Backwards engineer your statistics, but the percentage of time that commodities have beaten the S&P, the percentage of time on rolling 10-year periods would be fascinating to see. I sense it's now higher than I suspect. Maybe it's 35% of the time commodities win over a 10-year period, I suspect. But I don't know. I know I keep stats for stocks beating bonds here in America, stocks US versus international, and I keep track of percentage of time that each asset class wins over different periods of time, 10 years, 20 years. Because, America, we're very ethnocentric. Do you know that word? Ethnocentric means we just think we win everything. So why ever invest in the rest of the world, right?
That's for sure.
We always win. The American movies end with fireworks. The others end with like tombstones, right? So I'm being silly, but I'm also kind of aware of our Americanism, our Americanness. So, but if you do look at the amount of time, stocks, I don't have it. It would take me a moment to get my spreadsheet, but the amount of time that USA beats international indices, over 10-year periods of time, we win for 10 years. Well, it's 50-50. Interesting. Since 1970, half the time the United States wins, half the time international wins. But somehow the margin of victory adds up. Guys, somehow the margin of victory adds up in our favor. The margin of victory. It's very interesting stuff. So
I agree. I love that. I'm impressed. So you say the first the annuity. Real quick, that's a insurance contract. Is that right?
yes.
All right. And the other business, you basically help you basically do wealth management, asset management for. Is it wealthy individuals or all kinds of?
Well,
who's your target audience there?
More and more, it's people who want to retire within 10 years, who have more than $1 million US.
Amazing.
And what's easy, guys, is that's not hard to find around here.
Yeah.
That's not hard to find around here. It's hard to get them to say yes to you.
Yeah.
But they are walking around all over the place here. There's so much money in my neighborhood in this country. And so that's who I help. And my model is to make it easy for people. I don't have like crazy portfolios. I just use S&P, international bonds, maybe some tech ETFs or some tech mutual funds. I try and make it very easy for like people like your parents and my parents. I just try and make it very easy for these people. And I'm like a boglehead sitting here, if you would please, if you know what those people are. So
how did you start out though? It seems to me like a pretty tough business to start out and to be successful at.
Yes, absolutely. If I'm 51 years old, I've been doing this 25 years.
Yeah.
If I was 25 years old, I do not know how any new person starts in this field.
That's what everybody says right now.
Back in the year 2000, when I started, in America, I don't know the Swiss rules. In America, you were allowed to call people on their home phone, no cell phones. I would go to my office and work all day. Then at night, at 7 o'clock to 8 o'clock America time, East Coast, I was in Philadelphia. I would pick up the phone and call, "Oh, hi, Mr. Frank. This is Chris Camber, and I'm with Merrill Lynch. Do you need any investing help?" And unbelievably, 1 out of like 25 people would say yes.
Yeah, that's amazing. And that's how you build your customer stack somehow?
Yes. And then at some point, after 10 years, I did that for 5 years. And after 10 years, I didn't have to make phone calls because you would say, "Oh, Chris, it's me, Sylvan. Can you help my parents?" "Oh, Chris, it's me, Mag. I have some money. We ride bikes together. Can you be my guy?" So it takes a lot of years, but I do wonder, I have a little YouTube channel with like 80 followers maybe, which is nothing. And so I'm trying to build that up because when I go to YouTube, I actually believe people now. I believe the guy talking about investments who's kind of speaking my language, no crazy hocus pocus. I mean, the person who is a straight shooter. So I try to be a straight shooter. I believe the guy talking about fitness and vitamins. I believe the person talking about learning Spanish or whatever. So
Yeah.
I really think that where there's a lot of charlatans online and magicians, I think there's some good people telling good things. And I think if you find someone whose message resounds with you, there's some people who hate financial advisors like me on YouTube, but they make such a good case for what I would hire them. If I weren't doing this, I would be like, okay, you hate financial people, but you are making such a good message, I would hire you. You know what I mean? So it's interesting. And so I do think that, hey, I only need maybe 100 more people to say, hey, Chris, be our guy. And then like things are super good, So in my world, I need
Indeed.
maybe, if I have 100 customers now, guys, I need 100 more customers. And it's like super, super good times. Things are good now, but
Awesome.
I'm one super
Yeah.
good.
Yeah. Good to hear. Good to hear. Uh, do you sell in the end? Do you sell financial advice,
Yes.
or do you do the whole custody kind of thing as well? You know what
Yes.
I mean?
The both.
Oh
Both.
wow! All right, yeah. What's more common? Is it more common that people come to you and just want advice, and you'll tell them broker and which assets to buy and stuff, or is it more common that you'll do all of, like they'll literally send you their money and you'll do everything?
That's right. They literally send me all their money and
Yeah,
say, Chris, I always say, oh, Sylvan, this is what I think you should do.
yeah,
At this point, when someone's referred in, Chris, I work with your friend Sylvan, so, do my stuff. People just, I mean, there's a trust level. People just say yes. Some people sniff it out. Oh, that Fidelity fund, that Vanguard fund, okay. I like it. It makes sense. The people just say yes right now. I don't have a lot
amazing.
of, I don't, the positioning, to be honest, this is true. I don't really sell investments. I help people buy them. Hey, just buy this fund. It's so easy. Just buy this one.
Yeah,
This one we might have some trouble with. This one's going to be slow because it's the bonds. But do this. Use your IRA, use your 401k, convert to Roth IRA, all the strategies here in America. Um, that's what I do. I just try and keep it
amazing.
very easy. I mean, the investments aren't hard, guys. The financial planning is hard. All
Yeah,
these rules now in America, the tax rules, the IRA rules, the retirement rules, we got Social Security rules. The investments are easy. Go pick the Vanguard fund. Just
yeah,
go. Just go pick the Vanguard fund. My day's done. But the planning is the work. The planning is the work.
yeah.
The
I agree.
planning is the work.
Interesting. All right, awesome. Super interesting to hear from you. I'm glad you joined as well. Let's also Neil, let's also give you a chance, man. How are you? And maybe you can also tell us about your book.
Oh yeah.
Yeah, Neil, I lost you.
Do you hear me?
Yeah, now I can hear you. Yeah.
Yeah. Okay. No, well, so pretty fine on my end. The day was smooth as usual. Closing out another week, and as I anticipated to you, I didn't really read a lot of books on investments per se.
Yeah.
Um, could also say I didn't read a lot of books on day trading because I read two, and I was like, okay, this doesn't help me, to be fair. But
Yeah.
there were like maybe two or three that I read which I liked, but they weren't about teaching you how to trade or to invest, but it was more about the mentality, the journey, the mindset. One was, I think it was classical. It's the Reminiscences of a Stock Market Operator. It's kind of
Yeah.
biography of Jesse Livermore. And then I read another one, Best Losers Win, which was pretty cool because I'm not that much interested in the process. Like I already have my own process. I'm not committing
Yeah.
a lot of time to learn other people process. Now, of course, I'm talking about day trading. Of course, I'm not talking investing, which I'm here to learn about, in fact. But yeah, so
Amazing.
I'm pretty quote unquote virgin on the topic. So I thought to come into here mostly as a listener and try
Yeah.
to
All
grasp
right.
some pearls of wisdom.
All right. All right. Awesome. Yeah. All right then. I'll share my screen and I'll show you my pick for today. Where's all right, I'm trying to switch windows. Um, I thought about the book that had the biggest impact on me. Or just like I listen to a lot of investing books. I think I listen to every single one by Bogle as well. Um, also Warren Buffett. Um, and then this one just really clicked by Morgan Housel. Have you heard of it? The Psychology of Money. Have you heard of it?
Oh, me? No, not really. But I do like
Yeah.
everything which is psychology related. So yeah, I'm a firm believer in market psychology.
Yeah. It's I think this one is it's and I remember at the time it really flashed me. And then in preparation for this podcast, I mean for this meetup right now, I tried to gather the learnings and I think I have to re-listen to it. But in the end, I think it has some good messages. And so the first one, or like the overarching theme, I guess, is financial success is a soft skill where human behavior and psychology are far more important than technical expertise or raw intelligence. So I think we've also heard that many times from Jolly Munger and Warren Buffett. They say over and over, a good investor is not necessarily with the highest IQ. It's often about being disciplined and about recognizing when you have a really good opportunity in front of you.
Yeah.
So yeah, so this book it goes it goes through just in general, like what does money mean to us? What's our relationship with money? How a lot of the bias, like how that is obviously very subjective. Everybody has a different relationship to money, um, and we get different habits. And um, I liked this message from the book, which works for me. Maybe it doesn't work for everybody, but for me, money, the ultimate goal of money is independence. And you don't need that much to reach that, right? I think Chris, you mentioned a lot of your clients that have 1 million and want to retire early, and that 1 million can be enough, like depending on your lifestyle, or even less, right? Like even less can be enough. So I I like that message as well from the book. How the ultimate goal is independence, and if instead you spend all your money on very expensive stuff. I know a few Americans that definitely do that. Well, I don't know.
Is it really enough? 1 million?
No,
Like, you know,
I didn't want to stop in. Not in this neighborhood, no. In
Yeah,
some parts of America, yes, but not around here, no.
yeah,
exactly. That's what I was getting at. Like, if you think you
yeah,
can retire with 1 million in your banking account, especially in the America of today, I don't think is enough for your next 15, 20 years of life, right?
yeah.
Well, Neil, what country are you in, please?
I'm in Italy right now.
Okay, so, if you go to Rome, the rents are very high, the apartments are very expensive,
Absolutely, yeah.
but the food is not as expensive as here. American food is very expensive compared to Europe, from what I recall. It's your living expenses here that are the living expenses, the day-to-day expenses here are higher. And so that's the challenge here. So in America, I would tell somebody who comes in with $1 million, I said, look, I'll send you $50,000 a year. I'll send you $60,000 a year for 20
Hmm.
years, maybe more. Don't
Hmm.
do math on me here. I'm just saying stuff, right?
Yeah, yeah.
Hmm.
Look, I'll send you $5,000 a month, which is $60,000 a year. And more than likely, you won't run out of money in your lifetime. Is that enough? Yeah, 60,000. And then they call. But then what happens is they call. Okay, Chris, you're sending me $5,000 a month, but you know what? I have a medical problem. I need a car. My kids need money. I need
Hmm.
a roof. I need a new refrigerator. Send me
Exactly.
$10,000. No, it
Yeah.
doesn't break the plan. We've had exceptional returns here. In all investments, all stocks have had exceptional returns.
Yeah.
Nothing I've had anything to do with. And you're like, oh my God, this person, they just keep taking money and they still have money. This is amazing. So, you can look, you can read all the YouTubes, do all the YouTube videos, 4%. That guy who came up with the 4% rule, it's been 6% for the past 20 years, but what will it be for the next 20 years? I don't know. But
Yeah.
look, you take $60,000 a year until you run out of money, and then by that time you're 80 years old and you probably don't need the thing that the YouTubes don't address. I see this, guys. People need the money now, but when they're
Hmm.
80, they stop traveling. Less trips to Italy, less trips to
Yeah.
Switzerland, less trips even in America.
Hmm.
People in America buy houses in Florida. They go half the time. Then they can't go to Florida. They can't go to the beach because mobility, just age. It's horrible.
Yeah.
It's just lifetime age. When you're 80, it's so hard to do things when you're 80 than when you're 70. So, I can send you this money and then you're going to stop needing it. You're just going to not need it so much. Maybe there's healthcare you need money for, yes, but you're not going to be going out as much, golfing as much,
Hmm.
fishing as much, going to Rome. My people stop traveling because their bodies can't make the trip.
Hmm.
Can't go to the Vatican because his hip hurts. Can't
Hmm.
go to London because he has a chest pain or something. He, whomever, they can't. The age becomes the factor. So, yes, life expectancy is 84, maybe 90 years old, but from 80 to 90, you're just not going to spend as much money.
Interesting. Yeah.
But I mean,
The
that is
whole
cool.
I like the whole idea of the FIRE movement though. Just I think it stands for financial independence.
I didn't
Um,
read the book, The Psychology of Money. Maybe I did read this book. I don't recall. But as you guys are talking on, so like, is $1 million
mhm,
enough? No. Do you understand what utility of money means? Utility of money.
I guess how useful it is to
Uh,
you. Oh,
yes. So if you have $10 million, do you need $11 million? No.
probably not.
Yeah,
If you
man.
have $500,000, do you need $600,000?
Yeah.
Yes. So utility is very high at lower money and then very small as you get more, except for some people. I have people $10 million who he will fight me for that $20 bill. Like, Chris,
Hmm.
give me my $20 back.
Yeah.
Hmm.
So utility, there are some people, every dollar counts.
Hmm.
I'm in a
But
school, look, I need to get to 5 million US dollars and I'll be happy. So money is very important to me to 5 million. Then beyond that, I can give it away and be happy and c'est la vie. So utility and the psychology of money, then you say, well, Chris or Sylvan or Neil, why do you need the 1 million or the 10 million? Oh, so I can be with my friends, so I can travel, my kids, my family. So it's not the money, it's what money buys, and money buys freedom. So does the internet, by the way. Internet is freedom. The internet is
Um,
incredible. The internet
I
gives you freedom.
to to me also money does buy freedom, but I feel like a lot of people spend money unconsciously on things that they think will give them happiness, and then it doesn't give them independence or freedom at all. It just gives them an expensive car to maintain, you know.
Well, the fire movement, I'm sorry, that's what you kind of touched on. So Sylvan, you're right
Yeah.
about that. It doesn't buy happiness all the time. But the fire movement is a mindset.
Yeah.
Not a fire person. I am not a fire person, and there's no way. I just can't do it. I can't do it. I'm going to go to dinner on Saturday with my family. We're going to spend 300 US dollars, and I am not going to care. The fire person will never do that. And so I cannot be the fire person because I like to do things. But the
yeah,
fire
me neither.
person, the fire person can never be me. I have a fire client. I have a guy, 55 years old, $5 million. He's a fire person, and I cannot be him. It's incredible. The mindset is
No,
incredible. They don't buy clothes. They don't go to
really?
dinner.
Yeah.
But at 55 with 5 million, I'm sure you could have, you could still like feel financially independent and like never work again in your life, no? You don't think
Fire,
so?
the fire is, there are people who are fire who don't know they're fire. they just save, they don't spend. Then they hear this word fire and they're like, oh yeah, that is me. But I wasn't trying to be fire. I was just being frugal and thrifty. I was just being me. I hate spending money. I got a guy, he hates spending money. He hires me only because I'm like a psychologist for this guy. But it's like the fire thing sounds good. And then there's something fire coast. I want to make a video on the fire coast. Do you understand fire coast? It's
No.
like, hey, I'm fire. I'm 50. I have $3 million. I don't need to save anymore. I'm just going to coast. That person is so hard to find because what made you fire, you are not going to change. You are
Yeah,
not going to
yeah.
get to 3 million and then say, oh, now I can spend. The fire person is fire forever in my mind. They are just,
Yeah.
Yeah,
I
when it's ingrained in the brain, it's hard to get out, right?
Yeah.
I think so. That's as I think
Yeah.
so. I am not fire. And so
No,
I
me
know I
neither.
can't be. I know I cannot be. I cannot
Uh-huh.
be. I can't do it.
I heard there's different like movements within the movement, like people that are maximizing or optimizing for different ends. Like some of them are might be optimizing for complete independence, and those might be the ones that don't go to restaurants. But then there's others that might maximize for some sort of experience. They might value travel, and so they just try to get to a certain number, I guess, that will give them the returns they'll need to die with zero and to have as many of those experiences as they can while they're still here. But I
Yeah.
agree what you said about the mindset. Like usually the mindset that will get you rich, those are not the guys that will then suddenly turn around and like start traveling nonstop or something like that. You know, just
And
chill on the beach and drink
you
margaritas.
just become like Gordon Gekko, right? Always thinking about the money. The money is a bitch which never sleeps, right? And you're always thinking about stacking up more money. And you're not really enjoying life, in my view, especially if you do it while you're young, right? I mean, I think the secret is a little bit of a balance, right? You can save on some stuff, especially if you realize they're useless or they're not fundamentals, right? You don't need a new iPhone every single year, right? But I mean, other things you might want in your life, like going out for dinner with friends, having an amazing social life. I think there is a way where you can save and invest, but at the same time keep on having a satisfying life. That's the kind of life that I would like to have. I mean, I don't want to be some sort of an
100%.
ascetic eremit for, up until I'm 50 and then what? Most of the things I could
100%.
do when I'm young, I won't be able to do them when I'm 50 or 60. So what's the point? Yeah, I'm rich, but I lack the experience of life, especially my young life.
Yeah. Reminds me also of this famous triangle, and the caption is like you only have two at any given time, and the three things are energy, money, and I think time. And like when you're
Yeah,
young, you don't have the money. In your middle age, you don't have the time, and when you're old, you don't have the energy.
That's it.
yeah, yeah.
Reminds me a bit of that, and you need the money most when you're young. Um, you need the time most when you're middle age, I guess.
Well,
Just let me round off this because I want to just finish my point and then we can move on. But I didn't find that in a specific book, but I was doing research on just practical content on investing. I was and I started to write a book using AI, and this is one section from the book, and it's a lot. It's also on psychology. It's obviously on money, and it's some paradoxes. So, for example, the first one is basically the overarching theme of these paradoxes are what got you rich is not going to keep you rich necessarily. For example, the first one is you might get rich by being very active, you know, by getting up early, by doing workouts, by calling a lot of clients, by putting in a lot of hours. But when it comes to investing, like over trading, that might kill you, right? So
yeah.
investing is just a different game. And I forgot where I read all about that. It might also be in the book that I mentioned, The Psychology of Money. It might also be from that book. But but that's one paradox. And the next one is the intelligence one. And here I remember a famous example from Newton, who the confidence paradox is in the same vein, kind of, because
Yeah.
Newton.
He bought, then he sold, then he got back in, and he lost everything.
Exactly,
Yeah,
exactly. Like,
yeah,
obviously, a master of his field, super intelligent. He got so much confidence from his domain, and he brought all of that to the realm of investing, and it just killed him. Yeah,
yeah.
he bought at exactly the wrong time. He thought he could outsmart other investors. He got the FOMO as well.
Yeah,
Yeah, it's just.
you see that happening, right? You remember long-term capital management. They were genius, right? They got all their
Yeah,
algorithms, all their system, and they couldn't go bust.
yeah,
Turned out they could go bust, and they did, and they brought the entire market down with them, right? Because of the
yeah,
amount of things tied to that specific chain of events. So yeah, every system
yeah.
can fail at the end of the day. So as you said in the beginning, it doesn't take a lot or a very high IQ in this game. At least the way I
Exactly.
experienced that. Like
Yeah.
you could do to do my daily job, you could train a monkey, and the animal might be even better than me because it doesn't have a lot of emotional attachment to money. It doesn't even know what money is. It's just looking at the chart, doing stuff, right? And it's just pattern recognition. So the monkey could be better than me because it doesn't feel a shit for money. Doesn't
hmm
even know what it
hmm
is. So yeah.
Yeah, Neil, would you also say, like, when it comes to investing and maybe even day trading, that what's important is um, like maybe discipline, and the mindset, and like you said, not necessarily intelligence.
Yeah, I think discipline. It's like, if you ask me, because obviously I come from a different angle, right? So I started day trading and then investing secondly, right? But it's kind of the same. The way I say it, like the way I manage my positions on gold, it's like I look at a daily or a weekly chart of gold, and I just to simplify, what if it was a 5 minute chart or a 1 minute chart? And I'm treating it the same basically. And it's not rocket science. Like again, a monkey could do that. It's just simple triggers, simple patterns. When you see them, you act, and you just roll with a game plan, so that you are not scrambling around while trying to analyze market information in real time, because you can catch up with the market. There are algorithms right out there which are acting in milliseconds. They are moving billions in milliseconds. There is no way you can outrun your competition in the market. So you just need a structured process and discipline, applying it every single day, and having a daily routine, even outside of the screen, outside the markets. Try to take care of your sleeping cycle. Try to take care of what you eat. Try to have an inner dialogue with yourself. Are you feeling badly? Are you feeling good? What your emotions? Try to get in touch with your emotion. And everything at the end of the day, the entire process brings you to be able to execute very well. And same goes with investing, right? You could apply the same with investing. Do you remember when we were talking? I think it was Ben, which sold everything at the lows of April after the tariff
Hmm
shock. Again, it comes down to a lot of different things, but just imagine, as I always say, if the market goes up, right, just trim your positions down, get back to target
Yeah,
weight, so that you got dry powder on the sideline. And when the market tanks, not only you're not suffering the same amount of drawdowns compared to everyone which is holding that market, but you also have optionality. Money is optionality to buy back in something which is now at a discount. Maybe you want it, maybe fundamentally is good, but it was too expensive. The market is now rewarding you, giving you the gift of being able to buy it at a discounted price if you
it's
believe in
funny.
it long term.
It's funny how most people know that, but then when markets are at all-time highs, like I get all those friends asking me, "Is now a good time to buy Bitcoin? Is now a good time to buy the Nasdaq?"
Yeah,
And then the opposite, like when it crashes and crashes, and tariffs happen or COVID, and the world literally looks like it's gonna end,
yeah.
and I'll tell them, well, now is a good time to get in. And they'll be
And
like,
they're
are you
not going to buy it.
kidding me? Yeah.
Yeah,
So everybody knows those truths, but to execute on them, I think most people can't, and they'll get into the market when it's high, and
yeah.
they'll get out, and
Execution
they'll
is the
get,
hardest part.
a lot of them will get out when it's low.
Yeah.
Yeah.
But which is why, again, since we got Chris here, which is why, again, I think characters and professionals like, money managers and financial advisors, if you can't do it yourself, you need to lean on someone with the experience and, the guts to do what it's necessary when it's time. So it's not a fault, right? It's not a capital sin to admit that I got this money, but I don't have the skills, I don't have the tools, or the personality to manage them. Go find someone which can pay him his righteous fee and just live with that. There's no shame in doing so, right?
Correct. I hire people to even hang pictures on my wall because I cannot hang them straight.
Yeah, exactly, right?
I'm no different than a contractor. But no, I have to ask, please, have you ever benchmarked your results against one of the major indices to determine all this time and effort you may be spending? Is it paying off, or should you have just put all your money in the one index and gone?
Oh, I think I can't really do it because I'm in this business just for the last 5 years, right? So, but my 5 years, I could tell you that, I mainly have positions in gold. Gold outperform stocks, for instance, and uh, getting back to the value and the meanings we attribute to money, I could, work a 9 to 5 job and getting, I don't know, 2,000, 3,000, whatever I could get the same in a week by working like today, just 9 minutes a day. Like today, my work job was 9 minutes from 9:30 Eastern time to 9:39 Eastern time. And, you know, some people might say, yeah, but you're still working, right? If you had all this money, you could just live off a passive income and whatnot. Well, first of all, as you said, I don't know if I could do that. Like sitting on my hands all day while waiting for my mutual funds to mature and not having a meaning, a purpose in life, it wouldn't fit me. And secondly, I think when people compare themselves to a benchmark, like I mean, I read about it, and I guess it's nice to have a benchmark. Otherwise, how could hedge fund or money managers, come up with, saying to the clients, I was good, I was bad, I've beaten the market, or I underperformed, whatever. But, for me as an individual, I'm not so focused on the benchmark. Like I don't care if the S&P is up 26% this year, because maybe, my hurdle rate is different. I calculated everything to reach a result where I don't need to necessarily make 26% per year, or maybe I'm just more defensive. Like a lot of what I have as a savings, a bit of that is in gold. The rest isn't just, it's been for the longest time is money market funds. Because
Hmm.
instead of keeping them on my banking account being eroded by inflation, I was like, look, we have never had like 4.5% rates in the US. I'm gonna pull that money in. And I actually bought some 10 years treasury when the yields were at 4.4, something like that. And I'm
Hmm.
planning on keeping them because I don't see any reason to just sell them.
Just real quick, Chris, I really liked your question, and um, when my grandfather, like he got bank financial advice, and bank financial advice is notoriously bad. Maybe it's changing slowly, but it's notoriously bad because there's an incentive problem, right? But anyway, my first question also was like, well, what about measuring against the benchmark? Yeah, it went up in nominal terms, but what about against the benchmark? And secondly, what about fees, right? Like, yeah, like how much did you pay in fees? Personally, I haven't done the calculation with my own portfolio. I only have a gut feeling, and I know that for a long time I definitely did not outperform the market. Um, Maybe it changed a bit recently, but I should do that. I should. But I also try to stay closer to the total market portfolio. So I try not to deviate too far. But I should do that calculation. Why do you ask, Chris?
I'm always curious if I can. I don't day trade, guys. I do buy and hold. So the reason I ask is I always sit here and I say, why am I doing all this work? Why can't I just I'll just take $1 million and day trade. And my goal, no, if I had $1 million, how hard would it be to make $1,000 a day? That's all I want. Put $1 million in at some point, hope for a $1,000 increase, and go home. Now, some days it might go down $5,000. So then what do you do? And that's the discipline, the process you talk about. But I sit here and I think, can't you just make on $1 million? Can't you just make $1,000 a day? The market's open to what, 200 days a year. Can't you just make like $200,000 a year on $1 million? Like, can a day trader do this? Can a day trader do this? Can a day trader do this? I mean,
You
is it
mean
Mhm.
20% return on the initial balance at the 1st of January in a year?
consistently? Yes.
Yeah, absolutely, you can. Honestly, I don't see why not. I
Uh,
averaged from 35 to 47% over the last 5 years. So, yeah,
Neil,
yeah.
I was curious. You also we mentioned books, but I feel like you just and we also mentioned your process, and I feel like, correct me if I'm wrong, but I feel like you got to your process pretty intuitively. No, like you happen to have the right personality to be a day trader, or how was it? Like, how did you find your process?
Well, as many other people will likely do, or at least attempt to do, first of all, by losing everything, obviously, and so learning what not to do. And then, yeah, I've been in just one academy, to be quite honest, and that was enough. I didn't chase a lot of different courses or programs on the internet. I think one was enough for me. I got what I thought it was useful, and I discarded what I thought it wasn't for me.
All
And
right.
it's just a personal journey. Like, I mean, you can read the books, you can have, even if you have a mentor, in my view, the mentor will teach you what worked for him, but the mentor is not you. Doesn't have your own
Mm.
psychology. Doesn't It's not wired up the same. Maybe his risk aversion, it's not the same as yours, or maybe his intuition is not the same as yours. So it's very personal. There is no
Mhm.
one person which is like the other completely. It's all fractal, right? As humanity, as individuals, we are a fractal of humanity. We all have two eyes, one nose, two arms, two legs, but even if we got one brain, our brain it's not exactly the same. It's similar. It follows the same patterns, right? You got the same emotional response all across the board, but then everyone will manage his emotions differently. So teaching this, it's not something that you can just go to university to understand, because you can't do the same thing everyone is doing. If we were all doing the same thing, think about it. How would the market move? It's
Uh,
impossible, right? So again, but getting back to the question, I think there are a distinction that is needed to be made in between day trading and investing. To me, the way I see it, those are two different sports, right? Day trading is about building up an inflow, like a reliable inflow. When you invest, I think the reason why I decided to put a bit of money in gold and a bit of money in treasuries is because I wanted to possibly defend my savings and potentially growing
yeah.
them. So hence why I said I started day trading and then I started investing, because
Yeah.
before I didn't have half a million to put here and there, right? So I think you might be lucky, maybe your family is rich, so you don't need to earn that. But yeah, that was it.
Yeah, that's how most people get it, right? They'll work their ass off, and then, but that's why I like the psychology of money and the psychology of investing, because you'll just need such a different mindset and discipline when you start investing. I'm also like Chris. I also buy and hold mostly. I try. I try because I know what the research says, and I know what good financial advice is, and so I try to stick to it. But I can't help it but to speculate a little bit on the side, and like tilt my portfolio slightly towards whatever it might be. Right now it's small cap stocks, so we'll see. We'll see how that goes. Uh,
Would you guys think that I already have my prejudice or preconception about it, but in your view, is it better, like performance-wise, is it better to buy and hold or having an active management of your portfolio? I already know the answer for myself. I just wanted your opinion.
uh, Thank you, Joe. All right. Hopefully next time, Joe, you'll also get a chance to talk. Um, Neil, I think the answer is is clear.
All right.
Like active management, like at least when you look at statistics about like the more trades retail investor makes, the worse they perform, right? And also, um, even statistically, like if you look at the drivers of the market, there were a handful of stocks over the last few years. So the chance of you getting exactly those stocks is really slim, right? Um, yeah, Chris, what do you think? Does passive management beat active, or the other way around, or what?
That's why I asked Neil the first the question.
Yeah,
Him versus call it the S&P. I know he's been in gold. So you had an asset class that, S&P's up 90% for the past few years, 5 years. Gold's up 109. So from that standpoint, S&P and gold, we're lucky we're in the proper asset class. If you look at a SPIVA report, do you guys know? Sorry, let me get back to my Zoom screen. I was looking for my data. Do you know what the SPIVA report is? Do you know
no,
this
I
now?
don't.
I
S&P.
I heard of it, but please go ahead.
Yes, thank you. S&P index versus active. The
Yeah,
S&P Global Research looks at all the money managers.
yeah,
10% outperform, 90% underperform.
exactly. Yeah,
So, no, I do not. I take you first face value. I am glad you have done so well.
me
Some
too,
people
Neil.
will. Some people will. But I do think I would challenge anyone. You've had 5 years of success. Let's review this after 10 years and then 20 years. And you might say, well, Chris, I can't do it that long. Well, that's the game. That's the game, right? We have to do this forever. So the index versus active report, SPIVA, the
Hmm.
professionals, this is why I just used the Vanguard index funds. The professionals can't even beat the stock market.
Exactly.
Why can I? And to a nod towards Sylvan, look, I have individual stocks too. I have my Amazon and Apple and Microsoft and Google. I also have Garmin. Who else? I have something else, DraftKings. I have some things that have not
Hmm.
gone well. So you have to look at overall. I don't have NVIDIA. And so luckily I have QQQ. So
Hmm.
QQQ has done well because NVIDIA came out of nowhere, right?
Yeah,
NVIDIA came out of nowhere and it pushed the NASDAQ index up. So these dark horses come around and make incredible gains. And so since I had QQQ, I've had good luck with that chunk of money. But then components, other companies in the NASDAQ index, you have to look has to have the components kept up with the index. I don't know the stats for the past 5 years. How many companies of the S&P have outperformed the S&P? Probably 20%, 10%. I don't know. Like it's only a little bit who are
mm,
carrying the pack. So the pros, no, the pros can't beat the indices. 90% can't win, 10% can. I don't know who can. Like, Peter Lynch, that's the book I should read there. I guess he's got a book out. Peter Lynch, maybe that's the book I'll read for the next book club meeting that Sylvan
mm.
conducts. You
By the way,
know?
Chris, do you have a book that you wanted to talk
No,
about
I didn't know
today?
today was about a book, guys. I didn't read the whole intro. I
No
just saw there
worries.
was a Zoom, and I'm like, yeah, let's get on
No
this.
worries. Yeah, awesome. But Neil, I like your approach because I feel like you do your day trading. You obviously need some assets to do that, but you also have a margin account, so I assume you don't need a ton of assets. And I feel like you do it. You do it well. You got some savings, and the funny enough, with your savings, you're super conservative. You go into bonds
Yeah,
and
well,
gold right now. So I feel like the way you do it is is not a bad way to do it because once let's assume it stops working for you. Let's assume the markets changes, whatever you're exploiting now, whatever inefficiencies they disappear. Let's assume that, and but I think you would notice really quickly because your income would go down, but your savings would not because your savings are in gold and treasuries.
I mean, yeah, of course. Like again, as I see that as two sports, right? Two legs of the same thing, right? So on one hand, I'm building an income. On the other hand, I'm trying to protect that income that I accumulate. because otherwise, with the rate of inflation that we got after 10 years, what do I have, right? So I'm not stupid enough to think that I can just leave my money on my checking account, getting back in 40 years and expecting that the purchasing power will be the same, right? So, the choice in between gold versus an equity fund or an S&P index, it was because of the macro conditions that we are living in. If
Yeah.
you check geopolitical things, if you check the monetary system, if you check all the different dynamics, you could just relate to Brent Johnson if you never heard of him with the dollar milkshake theory, right? So he theorized back in 2018 that we were going into a period where the DXY versus other fiat currencies, gold and equities would have run to the upside altogether. Of course, with the different volatilities, different periods, at times one will lead and the other will lag, but just check the chart. Just check where the DXY was, let's say 2015, check where it is now, check where the S&P is, check where gold is. Now, you might say it's all money debasement, which I would agree on, right? But when you talk about money debasement, you just need to remember that not all currencies are created equal. So yeah, the dollar is debased as any other fiat currency. And in America, I know in the United States, they're crazy about the Fed is bad, the government is bad, the Treasury is bad, inflation is an hidden tax, which is totally true. The problem is, and we get back to the beginning, I think Americans often, they don't look past the backyard, right? They're only looking at America itself, but they don't realize that having the dollar somehow is it's a double-edged sword many times, but more often than not, especially in recent decades, it's been a blessing. They couldn't achieve what they are achieving, and even if they're moaning about it now, you need to realize that if the fiat money pack altogether, the euro, the yen, whatever, it's the basing. Well, the dollar is it's the base at a much slower pace. It's a relative gain. So you will see the euro suffering a bit more, I think, in coming years. You will see the yen. We're already seeing the yen. I think it's what 150 back again. So all those money will chase the best returns. And when you think about returns, like for instance, now this year, for instance, now you can say the S&P was up, I don't know, what, 12, 14, 16%, right? But I'm a European, right? So if I pour money into the S&P, and then when I want to cash out, I need to swap back into euros from dollars. If the DXY has fallen 10, 12%, I'm not up the same amount the S&P is up. Again, you need to consider that because currencies is the most important market you have. Forget the stock market. The stock market is a dumb market. It's all about fugazi, it's all about hype and all the rest. And you'll see what happens when this AI bubble will pop, since now they can't grow revenues anymore, so they need to create this profit cycling back where Nvidia finances Intel, and then Intel commit to acquire that and that from Nvidia, and it's just a recycling. But the point I was trying to make is that I try to defend my savings, and since I'm not strictly living in the US, I'm trying to look at it from a global perspective.
Right.
So that would be a point.
Neil, even though you try to be defensive, your savings seem to be pretty concentrated still, right? Like bonds can go
Yeah.
down, and so can gold. So yeah, I'm just curious. Like, have you thought about diversifying more in your savings?
Well, again, my choice was: do I buy gold or do I buy an S&P index? Or if I don't want to buy the index, would I commit the time to research 20 different stocks, looking at the fundamentals, looking at the news, looking at balance sheets and whatnot, considering that, I'm placing a bet. I got no certainties. I'm just placing a bet. So
Yeah.
my bet needs to be compared to the time that I'm consuming by studying it before placing it. And for me, gold was a no-brainer. Why should I be worried about Trump coming out saying this or that? Why should I be worried about Jensen saying this or that? Why should I be worried about AI, Chinese coming up with DeepSeek and having the S&P collapsing 10% in a day? I mean, there is
Why not?
very
Why
much,
not? Why
it's
not
much
getting
more
a
asymmetric.
why not getting a diversified portfolio and not worrying at all about any of that? Not
What
investing any time at all.
what is a diversified portfolio? Because that's another
That's
thing.
a good question.
I'm struggling with it. Like I just for fun, like I picked on the internet randomly. I asked ChatGPT to show me examples of what hedge fund managers and money managers are holding right now. And to me, there is a lot of redundancy. Like you got tech ETF, S&P ETF, Nasdaq ETF, dude, is all the Mag 7. Those three alone, those are all going up before because of the Mag 7.
No, no,
Is
it's
it
a
diversified
good
like that?
it's a good question. I for a long
I
time
would,
I thought, yeah, Chris, go ahead.
please finish your thought. I apologize. Finish your thought, please.
Just real quick, for a long time I thought it was just a 100% equities total market portfolio. Kind of, I would say I would prefer global diversification, maybe
Yeah.
market cap weighted. But then you hear researchers and they start talking about factors. And so you start thinking about a small cap tilt and a value tilt and a quality tilt and what have you. And so that's one aspect. And then you start talking, and then I did the page on stocks versus bonds, and I realized, wow, bonds, like a total return bond index actually does super well. And then you hear people like Ray Dalio,
Yeah.
and you see his portfolio does pretty well as well. So I would say a diversified portfolio is just 100% equities, but it's a rabbit hole, right? You can go down and you can find different answers
You might say different sectors inside the equity market. I would agree on
as
that. Like a
well.
little bit of healthcare, a little bit of communication, consumer discretionary. You make a mix. Then I would agree on that. Yeah.
Well, two thoughts. Let me just Sylvan first, and then to Nil, just back to what Nil does. So, Sylvan, I would ask you to consider making charts on your website that compare various time periods of asset classes, like 20-year rolling returns for stocks versus bonds, U.S. versus international. Compare the rolling returns, 5 years, 10 years, 20 years.
I
Compare
like
those
that.
returns,
Yeah,
okay?
that's good. That's good.
I like that idea.
And then, Sylvan, as you asked Nil to diversify or consider it, please understand this is my take on what Nil is doing. Nil is a business. Let's just say $500,000. His business has $500,000. His business is buying and selling gold. The other person, his neighbor, his business is buying and selling bicycles. His bicycle store is worth $500,000. He goes and buys inventory. He sells bicycles. He makes $100,000 a year. The coffee guy, his coffee shop is worth $500,000. So why not diversify? In my opinion, I don't know you, Neil, but my call on from learning about what you do today, you have a business. Your business is buying and selling gold. It could be buying and selling Swiss watches. You could be a Swiss watch guy and be buying and selling watches or jewelry on the secondary market. It doesn't matter. You have $500,000, and this is how you know how to make the most money off of your money. You buy and sell gold. You are, in my mind, you're a business. You're like, are you an investor? Well, in some regards, are you a day trader? Yes, of course, but you are a business. Your business is using your capital to make money, whether you're doing, again, coffee, bicycles, clothing. You're in Italy. You guys all dress so well, right? You could be buying and selling suits. You could have a suit. You could be making suits, and your
Yeah.
business is worth $500,000. No, no, no. I don't want to sell my business because I make suits. I make money making suits. This is what I know. So I see you as a business. And when you say, well, why don't you diversify? Well, he's an expert of gold. This is his business. I, I understand your question, but I think I understand. I see how Neil sees it too, because I see how all these people see these things. And so, yeah, I mean, you're just a business buying and selling your product, and just go and buy and sell as much as you can and make the most you can, because this is your domain expert.
I mean,
Diversifying may actually hurt his ability to make money, because now he's got to focus on the currencies, like he says, and small caps and pharmaceuticals versus tech and chips. I mean, you're hyper focused. It's wonderful to hear of someone who does this.
yeah, I mean, you come up with a very good analogy. I never thought about it in those terms, but yeah, I just got two different business models for each. Like
Yeah.
my day trading, it's mainly on indices futures, like ES futures and NQ futures, while instead on gold and treasuries, it's a much more slower pace, right? I'm
Yeah.
basically buying and selling spot, not using leverage. I'm not using futures contract. It's just spot. Right. But yeah, I think you nailed it. Yeah.
Amazing. You guys, just before we end this, just I'd like to hear from you real quick. Just some feedback and maybe how was today and what would you like? Is there anything you'd like to talk about in the future, in future meetups.
Well, if I may, I like the idea that the reason for today was the book club, but you allowed other conversations to occur. That was fantastic. I'm surprised. I was expecting to see hundreds of people on this call. So I thank you for allowing us to meet you. That's just wonderful. But I do think leading I think that's a great lead, Sylvan, just the book club. Here, read a book and let's talk about it. Or maybe if you did this, I apologize, I didn't notice. If you tell us the book to read, hey, here's the book we're going to be discussing. Not just talk about a book. Well, talk about a book you read is nice, or here's the book I'll be reading for the next month. You can read this one or some other one. Maybe I'll go read that Psychology of Money. I bet I can read that pretty quickly. So I appreciate the day very much. I just want to compliment you on it. And also, the three of us, it allowed for conversation more so than hundreds of people, right? So that was lucky for us too, joining you today.
Yeah.
No. So that's my thoughts here.
Thank you, Chris.
Yeah, I will join in, cheering up the conversation we had. And, it's funny because I was messaging with Sylvan on Discord, and I was like, yeah, but you realize if we were like 100 people, it would have been hard to have a real articulated conversation, right? So yeah, to some degree, right, we are very few people, but at the same time, I think you can have a different dialogue, a much more participated and focused dialogue when you are a few people. But yeah, for the rest, yeah, I guess even that idea of pitching up the topic for the next meetup, like a month ahead or maybe 2 weeks ahead, could be nice. So maybe people could build up the interest in advance and then sharing their opinion afterwards. Just before we go, I would like, could you, Chris, post the link to your YouTube channel in the chat? Because I would like to check that out. Because I have a YouTube channel myself, and kind of like you, I only have like 60 followers or something like that. So it's very small. I'm not,
Thank you.
not really
Sylvan,
pointing.
I'll do it. I'm doing it right here. Sylvan, I saw you followed me here on YouTube also during the call. And Sylvan, too, do you have a YouTube channel as well, please? Just may I know?
Yeah, I started doing it. It's we'll see how it goes. We'll see how long I'll do it. It's hard work for me.
Oh, no, they're very hard. And guys, too, when I do a video, I have to put it through my lawyers in compliance.
Wow.
Because when a pro in America does a video, if I'm a licensed professional, right? Almost like a doctor. So I can't just say, oh, everyone go take some medication, because you can't do that. I cannot say any specific investment on my videos. I can only say, oh, S&P 500 index fund.
Yeah.
I cannot say Intel. I cannot say Amazon. I cannot say SPYVOOGLD. I can't.
There's a legal liability there, yeah.
If I do, I have to have it approved by FINRA, our regulators, and it costs $400 to $500, and I just don't want to pay the money for my 80 people just to not even call me and buy.
Yeah.
100%.
They can sue you for what? Solicitation or something else, right?
It's communications with the public. There's an SEC rule about communicating with the public. If more than 25 people see what you're doing, you have to have it approved by the regulators. There's a rule like that.
Yeah. Okay. Got it. Yeah. Sounds logical. Yeah. Even your profession. Yeah. I get it.
I found it. I found your channel, Neil. I knew it was Total Trader, but I couldn't. My search wouldn't give it to me.
Yeah, but as you know, you watched it in the past. It's just, it's not really professional. It's more of a recap of what kind of struck me throughout the week and what was the chart, what was the setup that I was looking at. It's more of a conversation with myself. It's not really, I'm not legally liable, so I could say whatever I want, but I'm not doing anyway because I don't feel like it's moral to tell people what they should buy. I don't have a license. I don't have anything. So who am I to say people what they should do with their money, right?
Yeah, no, Neil, it's really impressive listening to you. You cover a lot of topics, especially a lot of macro, even though you do day trading.
Hey, I would say your voice. No, don't sell yourself short, man. Your voice is equal to ours. What do I know? No one can predict the future. You're as good to listen to as me, honestly. So
absolutely.
We're on the same playing field here.
100%. All right, guys, thank you so much for coming today.
Thanks, Sylvan. Thank you for doing it.
Thank you, Sylvan. Bye.
Nice to
Thank
meet
you.
you.
Bye.
All the best until next time. Thank
Yeah.
you.
Until next
Have a
time.
good
Bye,
weekend,
guys.
folks.
Bye.
Yeah, same. Bye.